Welcome to our One Source Tax Provision Functionality series and another episode. In this session, we're going to talk about the currency translation adjustment and how that gets calculated in the software and where it shows up. So I'm not really going to spend a lot of time within the software today because typically you will just get the final numbers there. But I just kind of want to bring our attention to the fact that where we're going to see the CTA show up is when we run our reports in the reporting currency. When you created your unit and you created your foreign unit, you set it up with rates, with beginning and ending spot rates and with weighted average FX rates that impact your pre-tax book income. And where the CTA gets calculated will be on your payable reports and your deferred balances. So it's really your two balance sheet reports is where you will see that CTA calculation. So let's just take a look at, I have an example here that I kind of put together for this test entity. So in my first column here, what I have is my local currency numbers. So there are no reports within the software that drop out this way, but I kind of exported out my local currency, which you can tell because it's in my header. And this local currency code will be pulled from the country or the currency you selected when you set up the unit. So that's what will show with your when you run your local currency report. So this is the payable that I'm taking a look at. And the payable is kind of interesting because we've got a mix and match of various things. So your beginning balance when it comes in is going to get translated at the beginning spot rate that you entered into the software when you set up your unit. So that's in the unit details screen, and it's going to convert using that beginning spot rate. Now your ending balance is going to convert using your ending spot rate. So where it gets tricky is all of the other little things in between. Now, if you remember, when you are entering your payables into the data entry screen or via import, one of the things you must enter is a translation rate. So what I'm showing here for my activity, I have some payments that got put in throughout the year. And you can see I have my fourth quarter payment. Now, this fourth quarter payment is a total of $5,547,000. But really, when I investigated to do this example to show it, it's made up of 3 different payments of the same local currency. But because they were entered on different days, they have different rates. So the translation, as you can see, varies from day to day. And I have a similar scenario for all of my other quarterly payments that were entered. So we're using neither the beginning spot rate nor the ending spot rate, but some rate that was used as of the time that the entry was made on the general ledger, which is when the check was cut, let's say. Now, anything that comes over from the tax provision that gets auto-posted, so your provision or your RTP, those are kind of considered P&L type items. So when they post over into the receivable payables, they are going to post using the weighted average FX rate. So with all of these various rates, how does the CTA calculate? In essence, it's the sum of the converted beginning balance activity plus activity minus your converted ending balance. Because remember, at the end of the day, you have to get from one spot rate and your ending balance has to be calculated at your ending spot rate. So all we're doing here is taking our beginning balance, adding all of the adjustments that we have, plus the weighted average FX rate conversion, and then backing out what the ending spot rate is. And that is what the CTA is on the payable. Gets a little bit more convoluted when we start looking at the deferred balances. So in an attempt to try to make this as, I guess, simple as possible, it's not very simple because of the various permutations within the deferreds. But as you can see at the top, I have my statutory rates. I've got my beginning deferred tax, my ending deferred tax rate, and my beginning and ending spot and the weighted average. So just remember, anything that you run through your deferred balances that has a P&L concept is going to get converted using the weighted average FX rate. And similar to the payable, we have to get from a beginning spot to an ending spot rate. So what I've done here is just taken my pre-tax balances. And this calculation over here is really an attempt to bring together a variety of different reports. When you run your deferreds and you convert it, you run your deferred reporting currency reports, you can get your reporting currency reports either by your balance sheet roll forward view. Then there is something called the CIR balance sheet view, which is a change in rate that breaks out the rate change column that you see here into two, between FX and actual deferred rate change. And then you can also get a deferred income statement view of the roll forward. So all of those, when we look at the calculations, have things showing up in different areas. And the income statement view is the only one when you run the reporting currency that actually allows you to see the currency translation broken out. And we know that currency translation does not have a P&L impact and runs through OCI. So if I go back over to my sample here, what I'm trying to show you is, here's my beginning balance. How does it get converted? So it gets converted. Let me just scroll over a little bit more because I have something that I'm missing. So it is my pre-tax number multiplied by my tax rate, my beginning deferred tax rate, and then divided by my beginning spot rate gives me my beginning balance. Now, when I get over to the FX change, I have a summation of a couple of things because I'm doing some other things over here. So the FX change, when you see that on your CIR, is actually going to be pulling together the currency translation that got calculated on the beginning balance plus any current activity plus any change on the rate for the beginning balance. So like I said, it does get convoluted. So if I just kind of pop on over here, you will see that I have a beginning balance CTA being calculated that's based on the statutory rates, the beginning spot. It's taken my total amount. So that was, go back over to my 1.3 million. It's multiplying it by my beginning deferred rate, dividing by my beginning spot rate, and then it's subtracting that same number calculated using the beginning deferred rate, but divided by my ending spot rate to come up with my CTA on my beginning balance. So all of your CTAs are going to do some kind of version of that. So I just kind of want to point out that for all of the individual columns, the calculation will do, and I actually do have some columns hidden here, but they had no activity. It's going to actually do a calculation column by column. So it can get very difficult when you're trying to kind of trace these numbers and figure out how the system is calculating them. But you can see that, for instance, my other prior year column is going to have a kind of, there's an other prior year balance sheet and an other prior year DO. My other prior year balance sheet is going to simply use my ending deferred and ending spot rates, but my DO column also will do that as well. But I have an additional component because my CTA on my deferred only column now is going to take into consideration my weighted average FX rate as well. And that will pull over into my CTA calculations. Right here, I am kind of attempting to show you the different items that go into my different types of balance sheet roll forward. So for instance, if I'm looking at my FX and my deferred rate change, you'll see I have them highlighted in blue. Those two, you will be able to see them in separate columns on the CIR report. However, if I back over again, you'll notice that the deferred rate change of 1852 will only show up on my income statement report because that's the only thing that's going through P&L. That FX rate change does not go through P&L. It actually goes over to the CTA. If I look at all of my other CTA, my CTA on DOs, you will see I have like 565 here and 104.4 because the RTP is kind of a DO as well. I go over, that's my sum that you will see CTA on D. And if I go over to my income statement version, you will see that's my CTA on D, which is telling me what got calculated as a currency translation adjustment related to deferred only items. So, like I said, this can become very complicated, but if you put together something, and unfortunately there is no one report within the software that kind of walks through all of these calculations for you, but the CTA is calculated using your spot rates and your deferred rates, as well as possibly your weighted average rates in the software. Hope you found this helpful and look forward to seeing you on another episode on our OneSource tax provision functionality.